You earned $5,000 in overtime. Your paycheck shows $2,850. That missing $2,150 isn't a payroll error. It's something most people never actually understand about how taxes work. This is the part where the system gets quiet about the real math. Here's what you're going to learn in the next few minutes: why your overtime is taxed at an effective rate you didn't calculate, how to find out exactly what your number is, and whether working those extra hours is even worth the trade-off. The reason this matters is simple. You're trading your time for money that disappears faster than you realize. Most people feel broke despite decent income because they're missing this one piece. Once you see it, the entire financial picture shifts. Let me show you. Almost everyone makes the same assumption about taxes, and it costs them thousands of dollars without them knowing. You look at your W-2, see that you're in the 22% tax bracket, and assume that means 22% of your overtime goes to federal taxes. That's where the math breaks down. The 22% bracket is real, but it's only part of the story. When you earn overtime, 6 separate tax obligations hit that income simultaneously. Federal income tax at your marginal rate applies first. Then Social Security takes 62% right off the top. Medicare takes 145% immediately after. If you earn above $200,000, an additional Medicare tax at 0.9% kicks in. And then your state tax percentage depends on where you live. Add those up and you're not looking at 22% anymore. You're looking at something that could be 30, 35, or even close to 47%. The system works this way because the government layers different tax types on the same income. It's not a mistake in how they calculate it. It's just that nobody explains it to you until you look at your actual paycheck and wonder where the money went. Here's where it gets real. Meet someone like Sarah, who works in manufacturing and makes $65,000 annually. She gets offered 100 hours of overtime at time and a half, which comes out to $2,885 of additional income. When she looks at her paycheck after that overtime period, here's what actually happened. Federal income tax pulls out $63,470 because she's in the 22% bracket. Social Security takes $17,887 from that overtime check. Medicare takes $4,183. Ohio State income tax takes another $11,540. That adds up to $97,080 in total taxes. She took home $1,91420. The effective tax rate on her overtime was 3,365%, not 22%. She expected to earn $2,885, but actually received less than $2,000. That's a hard realization. Now consider Mark, married filing jointly, earning $220,000 annually. His employer offers him a $10,000 bonus. Because his income crosses the $200,000 threshold, something different happens. Federal income tax at the 32% marginal rate takes $3, $200 Social Security takes $620, regular Medicare takes $145. Then the additional Medicare tax at 0.9% takes another $90. Because he's above that threshold, state and local taxes at 6% take $600. His total tax bill on that $10,000 bonus is $4,655. He took home $5,345. The government took 4,655% of his bonus. That's nearly half. He worked for money that was almost split directly with the IRS and state tax authority. In a minute, I'll show you the exact formula to calculate your own rate. But first, understand why this happens. The system taxes overtime at your marginal rate, because overtime income is added to your existing income, which means it falls into the highest tax bracket you've reached. That's how progressive taxation works. Your first dollar of income is taxed at the lowest rate, and your last dollar is taxed at the highest rate applicable to your income level. When you add overtime, those dollars fall into your highest bracket. Then separately, FICA taxes, Social Security, and Medicare apply to all wage income with no regard for brackets. They're flat percentage taxes that hit everything. Then state taxes sit on top of that. It's not that the system is trying to hide anything. It's just that income tax works one way, FICA works another way, and state taxes work a third way. And nobody takes the time to show you how they stack. Here's the calculation formula that you can use for your own situation. First, find your marginal federal tax bracket. You need your filing status and your current income level. Go to the IRS website and look up the current year's tax bracket schedules. Write down the percentage, then add 62% for Social Security tax, but only if you haven't reached the wage-based limit for that year, which adjusts annually. Add 145% for Medicare tax, which has no limit. Then check whether you're above $200,000 in income if you file jointly. or above $200,000 if you file single. If you are at an additional 0.9% for the additional Medicare tax. Finally, add your state income tax rate. Some states have no income tax at all, while others charge between 3 and 13%. The total you arrive at is your actual effective tax rate on overtime income. Let me show you concrete numbers that you can reference. For someone making $65,000 and filing single in a state with 4% income tax, the total is 3,365%. For someone making $150,000 filing jointly with a 5% state tax, it's 3,465%. For someone at $220,000 filing jointly in a 6% state tax jurisdiction with the additional Medicare tax, it's 4,655%. At $300,000 in the same situation, it's still 4,655% because the federal bracket doesn't climb further for them at that level. The insight that people miss is this: your overtime is not taxed the same as your base salary. Your base salary gets blended across multiple brackets and gets an effective rate that's much lower than your marginal rate. Your overtime, added last to your income calculation, gets taxed at the full marginal rate plus all the flat taxes. They're treated completely differently. There are 3 traps that most workers genuinely don't see coming. The first trap is the wage-based limit, and it applies specifically to Social Security tax. The Social Security tax rate of 62% only applies up to a certain wage limit, which changes every year. Once you earn that amount in W-2 wages, the Social Security tax stops. This means that your effective overtime tax rate actually drops significantly once you cross that threshold. If you earn $160,000 in base salary and then work overtime before crossing the limit, you pay the full effective rate, including 62% Social Security. But if you work the same overtime hours after crossing the limit, you don't pay any Social Security tax on that overtime income. Your effective rate suddenly becomes 62 percentage points lower. Most people don't realize their overtime tax rate actually improves partway through the year. So they might avoid working overtime early in the year when it's actually more expensive, and then work more later when it becomes cheaper. That's the opposite of what makes financial sense. The second trap is the additional Medicare tax, which surprises people because it's not explained clearly when it takes effect. Once your total wages cross $200,000 for those filing jointly, or $200,000 filing single, you owe an additional 0.9% Medicare tax. This is in addition to the regular 145%. Your employer might not withhold it correctly, which means you could face a surprise tax bill when you file. Most people don't notice this tax until they see it on their Form 1040 at tax time, and by then they've already spent the money. The third trap is withholding calculation during mid-year overtime. Your employer calculates withholding based on the assumption that your income for the whole year will follow a certain pattern. If you work a quiet few months and then suddenly earn $5,000 of overtime in 1 month, your employer's payroll system might not withhold enough because it's still spreading the calculation across your assumed annual income. You end up getting a smaller than expected paycheck, but not because the taxes are higher. You actually had insufficient withholding, which means you'll owe money at tax time instead of breaking even. The fix is straightforward. Contact your payroll department and ask them to increase your withholding before you take overtime hours. Don't just accept whatever the system calculates, but here's where it gets real. Is overtime even worth your time? That's the question that matters over time. Makes sense in specific situations. If you're paying down high-interest debt like credit cards, every dollar counts because you're paying 15 to 25% interest. Overtime income applied to that debt actually saves you more than the taxes cost you. If you have a specific short-term goal like saving for a down payment or building an emergency fund, and you have a clear number and a deadline, overtime is a tactical way to hit that goal. If you're trying to increase retirement contributions and you have access to a 401k, overtime income can be directed there, tax advantage before taxes are calculated. But if you're working overtime for vague reasons or because you feel like you should, that's when the math doesn't work in your favor anymore. Here's the honest conversation. If your effective overtime tax rate is 40%, you need to work 100 hours at $50 an hour to make $5,000. But you only keep $3,000 after taxes. That's 100 hours of your life traded for $3,000. Is that worth it to you? Not from some productivity perspective or some hustle mentality, but actually personally for your life. If the answer is yes, do it. If the answer is no, don't. That's the real decision. Most people avoid this conversation because it feels like giving up. But it's actually the most honest way to think about labor and taxation. In a minute, I'll show you strategies that qualified professionals use to minimize overtime taxes. But I want you to understand something first. These aren't loopholes These are legitimate ways that the tax code itself actually allows you to reduce your tax burden on that overtime income. They're not secret. They're just not advertised by anyone because there's no financial incentive to tell you about them. The first strategy is to increase retirement contributions if you have access to a 401k plan. Here's how it works. If you earn $5,000 of overtime, you can contribute that $5,000 to your 401k before the bonus is actually taxed. The contribution reduces your taxable income. If your marginal rate is 32% plus 765% FICA taxes, you save about $982.50 in total taxes on that $5,000. You keep the full $5,000 in your retirement account, and the taxes you would have paid go into your future retirement savings instead. The IRS allows this because they want to encourage retirement savings. This is one of the only places where the tax code actually benefits you if you understand the mechanics. The second strategy is to adjust your Form W-4 specifically for overtime periods. Instead of allowing the automatic withholding calculation to assume you're earning at a normal monthly rate, you can have your employer recalculate based on your actual expected income. This doesn't save you taxes. You'll still owe the same amount at year-end, but it improves your cash flow because you're not giving the government a huge interest-free loan during the year. The psychological benefit is that you feel the effect of the true overtime tax rate more acutely in the moment, which actually helps you make better financial decisions. The third strategy, if you're self-employed or have any side income at all, is to understand that business expenses become deductible. This is where business owners have an advantage that salaried employees don't. If you're self-employed earning overtime through contracting, every legitimate business expense reduces your taxable income. Office supplies, vehicle mileage, equipment, software, professional development, these get subtracted before your tax rate is applied. A salaried employee doesn't get that benefit. The fourth strategy applies to high earners and is more complex. The income timing strategy. If you earn high enough that you're concerned about tax brackets and thresholds, you can sometimes coordinate when you take overtime hours to manage your overall tax outcome. For example, if you can choose to take overtime in Q4 instead of spreading it throughout the year, you might be able to synchronize it with estimated tax planning or other income decisions. But this requires professional guidance, and it's not for most people. Now you have the formula, the examples, and the strategies. Let me put the visual picture together so you can see it clearly. Take a $5,000 overtime payment. Federal income tax at 22% takes $1,100. Social Security at 62% takes $310. Medicare at 145% takes $72.50. State tax at 4% takes $200. That's a total of $1,682.50 in taxes. You keep $2,317.50. Compare that to a base salary $5,000 payment. If the marginal rate on your base salary were lower, say 12%, federal tax takes $600. Social Security and Medicare take the same amounts. State tax takes $200. Total taxes equal $1,182.50. You keep $3,817.50. Why the difference? Your overtime pushes you into a higher federal bracket, so every dollar of overtime is taxed at a higher marginal rate than your base income was. Most people miss this because they look at their W-2 and see one average tax rate, and they assume everything was taxed at that rate. The system works differently. Your first dollar of income gets taxed at one rate. Your last dollar of income gets taxed at a much higher rate. Overtime income is your last dollar, so it gets taxed at the highest rate. That's how progressive taxation actually functions, and it's the entire reason why working overtime can feel like you're barely getting ahead financially. Let me be direct about what this means for your actual life. If you're working overtime and you feel exhausted but your savings account barely grows, this is probably why you're trading significant time and energy for money that the tax system takes a large percentage of before you ever see it. This doesn't make overtime bad. It makes the situation worth thinking through carefully. Some people genuinely need that overtime income. Some people are making a psychological calculation that the stress isn't worth the after-tax return. And that's actually a rational conclusion. The important thing is that you understand which one is true for you based on numbers, not based on what you think you should do. There's one more piece that completes the picture, and it's about something most people don't consider at all. The wage-based limit for Social Security is important because it creates a situation where your effective tax rate on overtime actually improves partway through the year. If you can shift your overtime to the second half of the year after you've already crossed the Social Security wage-based limit, your effective rate drops significantly. You're not paying that 62% anymore. In the second half of the year, if you're making the same overtime hours, more of that money actually makes it to your bank account. This is counterintuitive because everyone talks about working harder early in the year, but the tax math actually rewards you for working overtime later in the year. Most employers don't think about this when they're offering overtime. So if you're the one suggesting when you want those hours, you have an information advantage that you can use strategically. The final thing to understand is that this knowledge actually puts you in a different position than most workers. Most people just accept whatever their paycheck shows them. They work overtime when it's offered. They get paid less than they expected, and they accept that as normal. But you now understand why. You can make a conscious choice about whether overtime makes sense for your specific situation. You can negotiate timing of bonuses and overtime. You can structure retirement contributions strategically. You can have a real conversation with your employer about your W-4 withholding if you're about to work overtime periods. These aren't aggressive tax avoidance tactics. These are just using the information that most people don't have. Here's what you need to remember going forward. Your overtime is taxed at your highest marginal rate plus all FICA taxes plus state taxes, not just your single tax bracket rate. This effective rate is probably between 30 and 47% depending on your income level and state. The wage-based limit creates a situation where your overtime tax rate actually drops partway through the year. You can reduce the tax impact through strategic retirement contributions and withholding adjustments. Whether overtime is worth your time depends on your specific financial goals and what you're trading your time for. Comment below with your own effective overtime tax rate once you calculate it using the formula you learned today. If this video changed how you think about overtime or taxes, subscribe so you see the next financial system breakdown that might shift your perspective again.